All right. Hello, everyone. Welcome to this session, and I'm glad to see you all join here. Yesterday, we had covered this ratio analysis, the overview, the basics, and capital structure ratios. That video, if you missed the yesterday's session, you can still attend that session on YouTube or on our Facebook page. All right. So I hope you all have clarity about the basics, and even if you have some questions, what I will do is once I start the session today, I will cover the no worries Archana. I will, because I will be quickly revising whatever part is relevant in the session today. All right. So today we will be studying income statement and the P&L part, and therefore first we will study about that how to calculate profit and everything, and then we will move on to the ratios. All right. I see this series is very important because I will cover the complete ratio analysis part from with the series itself. All right, because SuperProfs is conducting this stay home study online free live series, so I thought that it would be better if at least one complete topic can be taught. And because this is so important, so we will also be covering practical problems in this series itself. All right, so without wasting much of your time, I will start now. Now let's study about the income statement or the P&L. All right. So you remember the example that we have taken and all the numbers. Okay. I have mentioned them here. Okay. Now income statement. All right. In this, what we try to study is the different, cost and what is our profit, what is the different cost, how much money is there with the, firm. All right. All these things we'll be able to determine once we complete this. So let's say that the sales for our firm is in because earlier we have taken in lakhs of rupees, so let's say that it is 2000 lakh rupees. All right. Now let's say when you when you have to find the profit or of anything, what you do is you try to find out okay, or let me take a very simple example. You say that, hi, I sold apples of 10,000 rupees. Okay. And the other person might say that, okay, you sold them at 10,000 rupees. What was the cost that you had purchased them, right? And you say that I made a very good profit of 2,000 rupees because I had got the apples for 8,000 rupees only, right? This is a very simple example. You all know this, right? Or let's say you go to buy a ticket, all right, and a movie ticket, and you are not able to see the movie, all right, and you bought this ticket for 400 rupees. Okay, and you tell your friend that, okay, I cannot watch this movie, so if you want you can take these tickets from me. And your friend says, okay, but I don't want them for 400 rupees, I want them for 300 rupees only. So this is the cost to you, right? And the friend buys it at a lesser price, so you are at a loss, right? So now let's take that example. So let's say sales of the firm is at 2000 lakh rupees. All right. Now what you need to know is what is the cost of the goods which are sold at this price. Okay. And so the term is cost of goods sold. Okay. How you calculate this cost of goods sold is you calculate the opening stock. Okay. Because for any company there would be a few inventory which is already there, right? So there will be an opening stock. Okay, then you will add the purchases, that okay, there were already 100 units, I then purchased earlier. Okay, then I purchased items worth, let's say, 200 rupees. Okay, and then because once out of these purchases maybe you had purchased 1,000 units, right? There may be, then out of these 1000 units, only 500 were used. Therefore, there is a closing stock. Okay, if 500 were used, then 500 would be left. So you subtract the closing stock. Okay, so opening stock plus purchase minus closing stock plus the wages and the factory expenses. Why? Because wages and factory expenses are directly related to creating these goods. Alright, so basically all the inventory, okay, and the cost incurred in creating these goods. Alright, so the cost of goods sold is opening stock plus purchase minus the closing stock plus wages and factory expenses. For our discussion, let us assume this is 1400. Okay. Now, just like your simple example of selling apples, once you subtract this cost of goods sold from sales, right, what you get is the gross profit. The amount that you get is the gross profit. What does gross profit mean? See, there will be two terms which we'll be discussing again and again: gross and net. Okay, profit. Now, gross profit is overall, that talking just in terms of the goods which have been sold. Right? This is the gross profit, that the cost that you have taken is only in how the goods have been created. However, for organization, you have to pay taxes, you have to pay interest, right? There are so many other things that you have to take care of. There are so many expenses which are operating expenses, right? There is maintenance. So all these expenses are additionally there. So once you subtract all these things from the gross profit, that is when you will get the net profit. Okay. Now we will study this one by one. Alright. So what we have discussed is gross profit is your sales minus cost of goods sold. Okay. So now we know two things. First of all, cost of goods sold is opening stock plus purchase minus closing stock plus wages and factory expenses, and gross profit is sales minus cost of goods sold. Perfect. Now, as I said, operating expenses. What you need to deduct from this gross profit is the operating expenses. Alright, and these include depreciation. Alright, so for the sake of our discussion, we will assume the operating expenses to be 300 lakh rupees. If you are still not clear as to what this operating expenses is, alright, you need to understand that there will be a lot of aspects, or cost which will incur in terms of running the business. Right? Because let's say we took this example of the manufacturing company, and wherein we know that there is a factory. Alright, so in the factory there will be different machines, right? And there would be wear and tear of these machines, right? There would be a depreciation value, right? Because they need maintenance, and all these costs are additional. They will incur with time, right? Then there may be some administrative costs for running the business. So all these costs, whether there is wear and tear, there's depreciation, any maintenance cost, any administrative cost, all these different costs, they are calculated in the operating expenses. Alright. So you have gross profit 600 lakh rupees. You have operating expenses of 300 lakh. Okay. Once you subtract the operating expenses from the gross profit, okay, what you get is the operating income. Alright. The 300 lakh rupees here, 600 minus 300 gives you 300 lakh, and this is your operating income. Why operating income? Because from this income you can run the business. Okay, and it is the earning before interest and tax. Okay, EBIT, operating income, is also called EBIT, which stands for earnings before interest and taxes. All right. Okay. So from the revenue, the kind of money that you are left after deducting, the operating expenses from the gross profit, you will be left with the operating income, that is earning before interest and taxes. Now the question comes, what is this interest and taxes? Right. Now let's go to the example that we had taken. All right. In this firm of the 500 lakh rupees capital, right, the source of funds were your equity share capital, reserve and surplus, preference share capital, debentures and term loan. Now remember, these two sources, that is debentures and the term loan, right, this was taken from borrowers, right, and you had promised that you will give them a fixed rate of interest. You will give them a fixed interest. This interest that is to be paid, in lieu of debentures or the loan, this is what you have to subtract from the operating income. Okay. And how do you calculate this interest? Now you see the numbers are pretty they are already mentioned here. So 15% of 100 lakh rupees. Okay. Similarly, 18% of what? Of the funds that they had given, that is 200 lakh rupees. So 15% of 100 lakh, which will be what? 15 lakh rupees. Okay. This is your debentures interest. Okay. And 18%, okay, of 200 lakh rupees, which is what, your 36 lakh. So overall 51 lakh rupees is your interest. Okay. So then you will subtract 51 lakh from this operating income, and what you will get is, this was what? Earning before interest and taxes, right? So this will be earnings before tax, because you have already subtracted interest, right? So what the amount that you will get after deducting interest from operating income is earning before tax. Okay. And this is also called as profit before tax. Remember, this is already, you're talking about profits only, right? So this is also called profit before tax. And just subtract this, you will get 249 lakh rupees. Okay. So till now, is this clear? See, once you deduct, you get overall sales. You deduct the cost of the goods sold from the sales, you will get gross profit. All right. Whatever business expenditure, whatever expenses you have for running the business, that is operating expenses, including the depreciation. Once you deduct them from the gross profit, you will get your operating income or earnings before interest and taxes. Okay. From this operating income or EBIT, once you will subtract the interest, you will get EBT or PBT. Okay. That is earning before tax or profit before tax. How you calculate this interest is, this interest is nothing but the interest that you owe to your borrowers in lieu of the funds that they had given. So this will be calculated at whatever rate that you had promised them, multiplied by whatever funds they had given. Okay. You may ask why we have not included this in interest, because this is your owner's fund. All right. And therefore the money where you have to give this 12%, right, of 50 lakh, this is to be given from the profits, and we will study this very shortly. Okay. So now coming back, we have now calculated the earnings before tax or profit before tax. Okay. Now the next component will be tax. Now let's assume, for the sake of our example, that the tax that we have to calculate is at 40%.
Okay, and this tax will be calculated at this. So 249 into 40%, right? We can take this approximately 100 lakh rupees. All right, and so your finally, therefore finally, what net profit is, it is earnings after tax. Okay, EAT or PAT, that is your net profit, and in this example, it is 149 lakh rupees. Okay, your net profit is earning after tax or profit after tax, and you calculate this by deducting the tax component from the ABT or PBT. Okay, now this money is your net profit, and this is to be used, this is your profit which needs to be divided among your shareholders, or you may decide that, okay, I need to retain this, okay, and this will go into my retained earnings, okay, because I need to run my business with this money. Okay, who decides all this thing, that where will this profit go? The board of directors, right, or the management. They will decide that, okay, we either we need this money to completely go into business, or a part of this should go to stakeholders for the profit, and the other part should be as used as retained earnings. All right, all these things, they will be decided by the board of director or the management of the company. All right, so this decision making, as in when they decide that, okay, where will this profit grow, how much will be going to where, that is called your appropriation of profit. Therefore, the starting point of appropriation of profit will be the net profit, okay, or the profit after tax.
Let's take net profit, which is in our case. Alright, so is there any query till now? Is there any question, any doubt till now? Very helpful. Alright, so in case there is any issue, right, you can raise your hand, or you can, tell me over the chat, and I will stop and explain it. So now we'll continue.
₹49 lakh. Okay, now what you need to give is, obviously you need to give money to your equity shareholders and your preference shareholders, right? Because this we have already paid out. Already, tax liability we have already paid out. Who's left? It's either your preference shareholder or your equity shareholder. Now, that is the difference. In preference shareholder, this is what you have to pay first. Okay, now this was calculated at 12%, right, in our example. Now I need to know, how will you calculate the preference dividend? How will you calculate the preference dividend? Will it be 12% of 149 lakh rupees? No, because this preference share capital is calculated at this, they have given this 50 lakh rupees. Therefore, the interest needs to be multiplied by 50 lakh. So, preference dividend would be 12% of 50 lakh rupees, which is your 6 lakh. Okay, so then you will subtract this and you will get 143 lakh rupees. Okay, which is earnings available to equity shareholders. Right, earnings available to equity shareholders is therefore equal to PAT minus preference dividend. Okay, so we are left with 143 lakh rupees. Now is when you will decide that, okay, out of these 143 lakh rupees, do I divide them into, as dividend completely, or do I take an amount as retained earnings? So let's assume that the management decided that 40% of this profit we utilize into the business. Okay, so which is 57 lakh rupees. once you subtract this, once you subtract the retained earnings from earnings available to equity shareholder, that is when you will get your equity dividend. Okay, and in this case equity dividend is 86 lakh rupees. Okay, now please note here that if the management decides that they do not need any retained earnings, alright, in that case they can give 100% of this earnings available to equity shareholder as the equity dividend. Alright, if they do not, if they decide not to keep any of the earnings in the in the business itself, if they do not keep any money in the reserve and surplus, then the whole of the money goes to the equity shareholder as equity dividend. Now in this case you might decide, you might think that okay, that does that mean that to equity shareholder this retained earnings is a loss? Well, no, that is not the case, because this 57 lakh rupees, it is of the equity shareholder only. All right, but they are just deciding to put this into the business for the time being. All right, so even in your balance sheet, you will write this amount as the reserve and surplus as the liability, because you need to pay this out. Alright, so always remember, retained earnings is not a loss to the equity shareholder. They are just giving this money to run the business for the time being. Alright, so I hope all these concepts are clear to you. Alright, you should go through this once again and revise it properly.
All right. So that was about the appropriation of profit. Do you guys want to continue further, or should we continue in the next session for further ratios? You can tell me on chat. Actually, with SuperProfs, they have the next session also. Archana, your question is, where does 6 come from? How does preference dividend come to 6? Is that your question? Okay. So see, preference dividend is also, okay, let me just explain. See, just like we calculated interest, no? That interest was calculated that 15% of 100 lakh and 18% of 200 lakh. Similarly, in preference share capital also, what you have to pay back is fixed. Alright, and the rate of interest is provided to you. So when you, in appropriation of profits, when you are calculating the how much preference dividend that you have to pay, that will be calculated at whatever is the amount and whatever is the interest. So 12% of 50 lakh rupees, okay, and this would come to 6 lakh. All right, because preference share or debentures or term loan, how much you have to pay is fixed right at the time of sourcing. All right, so that's clear. Is there any other doubt that any of you have? No. All right, so tomorrow we will continue, tomorrow or as per the schedule we will continue from here itself. All right, or do you want me to continue right away? You can tell me on chat. Are you guys not paying attention? I don't see any one of you saying that it is enough or not. Archana, this. We will cover, everything in detail, which are the operating expenses and everything. Okay. All right, so we'll continue for some time. All right. Hmm. Okay, give me a second.
We know how we have come to this net profit. All right, now we'll talk about some of the ratios. Now see, whenever you're talking about income, okay, there are two aspects, and one is your sales, okay, and in terms of sales, either there would be some kind of profit, okay, or there will be some cost, okay. So the ratios that we are going to talk about now, they will be whether we are talking about, discussing about the profitability or the loss in terms of sales or the expenses, okay, with respect to your sales. So we will discuss two kind of ratios. One is the profitability ratio and the other one is expense ratios. Now the very first profitability ratio will come directly from the gross profit, okay, and that is gross profit ratio. Okay. Now what is your gross profit? Gross profit is simply your sales minus cost of goods sold. Okay. So gross profit ratio becomes gross profit divided by sales into 100. Therefore the value will become 600 upon 2000, which will be your 30%. Okay. Next is net profit ratio. Okay, let me just write down 600 upon 2000 into 100. Net profit would be, your net profit came down to 149. So 149 upon 2000 into 100. Finally, what will be your operating profit ratio? As I told you, your earnings before interest and taxes is your operating income or your operating profit, right? So operating profit ratio would be this operating profit, that is 300 divided by 2000 into 100. All right. So you can see that the profit is calculated with respect to the common denominator, that is sales. All right. So these profits are very easy to learn. All right. You know what gross profit is, you know what net profit is, and you know what operating profit is. All right. When you're talking about gross profit and you get this value, all right, what this means is that for every 100 rupees, 30 rupees are your profit, okay, gross profit, and 70 rupees was the cost of goods sold, right? Because gross profit plus cost of goods sold will be completely sales, right? Okay, so that means 70 rupees is your cost of goods sold. So this is one view. This is the profitability ratio. Similarly, if you will calculate the expenses, that is, let's say 70, that is the cost of goods sold upon sales, that will give you one of the expense ratios. All right. So the very first is cost of goods sold ratio, which is cost of goods sold, okay, which is 1400 upon sales, okay, in 200. So this will come out to 70. All right. So these both are corresponding to each other. One is the expenses, the other one is gross profit. The second one is operating expense ratio. Again, as the name suggests, what kind of expenses are you going to divide here? The operating expense. What was the value? 300. So here it will be 300 divided by 2000 into 100. Okay. And the third kind of expense ratio is your operating ratio. Now do not get confused between these three ratios. One is operating profit. The key term being profit here. Alright, so you divide operating profit by sales, and operating profit is your EBIT or operating income. Okay. The second ratio is an expense ratio, which is operating expense ratio. Again, as the name suggests very clearly, here you have to take the operating expenses, divide them by sales and multiply by 100. However, the third kind of expense ratio is operating ratio, and this means you take both the costs, both the kind of expenses, that is cost of goods sold and the operating expenses. Okay, you take both these costs and then you divide them by the sales and you will get your value. So what is the cost of goods sold? That is 1400. What is the operating expenses? 300 divided by 2000. So 1700 upon 2000 is your operating ratio. The third kind of ratio is return ratio. Alright. Now what does return mean? Return means like if you invested something, right? How much money are you getting in return for this investment? Alright. And based on this very definition, okay, the very first ratio is your return on investment or return on capital employed. Okay, and what would this be? Return on capital employed means you have to determine what is the return or what is the profit, how much have you earned against the capital employed. So in the denominator you will take capital, okay, in the numerator you will take your profit, which is your EBIT, the earning before interest and taxes. So 300 upon capital, you remember in the last example we had taken capital to be 500 lakh here. So 500 lakh rupees capital. So you will take 300 upon 500 and this will give you your return on investment. The next one is return on assets, wherein you take the profit after tax or the net profit. Alright, so 149 upon the average total assets, whatever the total assets value is. And again, in our previous example, we had taken the value of total assets to be 600. Alright, so this will be your return on assets. Now, first you have calculated return on your capital employed, then you have calculated return on average total assets. Now the third one is return on equity. Okay, now remember, here we have talked about capital employed, so therefore we have taken the complete capital. Alright, whether it was the owner's fund or the borrowed fund. Alright, but in return on equity, okay, this will be calculated only on the owner's fund. Alright, because it is the denominator has to be equity, and equity is what? Your preference share capital, your shareholder equity, and the reserve and surplus. Okay, so you will take your profit after tax, that is the net profit. Okay, and average shareholder fund, which was, as you can see, it was equity share capital plus reserve and surplus plus preference share capital. The value was 200 lakh rupees. All right. So this will be your return on equity. All right. So far we have covered three kind of ratios: profitability ratio, in which you calculate gross profit ratio, which is gross profit divided by sales. Then you have net profit ratio. Again, the numerator is net profit and you divide it by sales. Third one is operating profit, in which you divide the operating profit or operating income, or EBIT, by sales. The second kind of ratio is expense ratios, and in this you calculate the different kind of expenses, whether they're the cost of goods sold, whether they're operating expense, or the overall operating ratio, in which you take both the kind of costs, that is the cost of goods sold as well as the operating expenses, and divided by sales. The third kind of ratios are the return ratios, in which you calculate how much return you have received against either your capital employed, alright, or against your assets, or against the equity, which is that of the shareholders. Okay, the key point to remember here is, when you're calculating the gross, that is the return on investment, okay, or return on capital employed, in that case you will take earnings before interest and tax, that is the operating income, in the numerator, whereas in return on assets and return on equity you will take profit after tax, that is your net profit. All right, so the next part is stock market ratios. Now
We will stop studying further today. All right. Stock market ratio, from stock market ratio, we will cover tomorrow. All right. You will get this video recording on YouTube in a very short while. So make sure you revise this. All right. And when you come tomorrow for the session, you are able to recollect these concepts. All right. See, financial management may seem to us that it is very difficult, but if you have the basics clear, then practical problems will be very easy for you to solve. All right. So if there is any question, any doubt that you have, you can ask me. Or if there's anything you want to say, or you would like me to cover additionally, you can tell me through chat. If there's no other doubt, then I would wrap up the session today. Have the concepts been clear to you? Are all of you able to understand what I've taught so far? All right. Thank you, Ananya. Archana, from my side, I will be covering this ratio analysis part of financial management. There will be other, professors who will be who will be hosting more webinars. And for that, you can follow SuperProfs blog, or even, write to support@SuperProfs and confirm from them. All right. Thank you, Shruti. Shruti, I saw that you were there in the session yesterday also. Make sure that you attend the complete series regularly. All right, this will be helpful for you all. All right, by the way, the complete course in both 100% English and English in the mixed language, both different courses are available on SuperProfs. So you can sign up and check the course there. All right. And you can also save that link on, join link. We are also active on Telegram, so you can, if you join the Telegram group, if you're active on Telegram, if you join that, in that case, you will continuously get the timetable. All right, I'll just share the Telegram link. Tomorrow, same time, give me a second so I can check the schedule when the next session on the same is. Yes, tomorrow, same time at 6:30 p.m. We will continue with this session. All right. If you have any friends in, who are trying to study for CSE, ET, or any other exam, you can suggest them to study from our free online this webinar series also. All right. I shared the link on Telegram, and if there is anything else, you can ask me, or I will wind up the session. Sorry. Okay, just give me a minute. Right. Yep, this is the correct link. The previous link was wrong. This is the correct link that I've sent right now. All right. Is this link working, Archana? All right, perfect. So thank you everyone for staying in the session and attentively listening. All right, and we'll continue at same time tomorrow, 6:30 p.m. for financial management. We will cover session in complete English so that all of you can understand. Thank you and have a nice day.